Assalamu alaikum and good afternoon, everyone. Abdullah Umar here, and on the behalf of Al Jazeera Capital, it is my pleasure to welcome you all to Jamjoom Pharma Q1 2026 earnings call. With us today, I am pleased to have the Jamjoom Pharma management team on the call. We have with us the Chief Executive Officer, Dr. Tariq Hosni, Chief Financial Officer Mr. Anwar Mohyuddin, Associate Director of Finance and Head of IR, Mohammad bin Khalid. Just few words on the format of call. The call would start with a 20-minute presentation from the management, which will be followed by a 40-minute Q&A session. I will now hand it over to Tariq Hosni to begin with the presentation.
Thank you, Abdullah. Assalamu alaikum, everyone. Hope all is well. Pleased to share with you our quarter one 2026 results. Another resilient and strong quarter, despite the headwinds that most of you are aware of. So without further ado, let's move into the first slide to share the numbers. So basically, as some of you have seen in our announcements on first quarter results, the revenue this is our strongest quarter year to date since inception of the company. So for 81 million Saudi riyal, representing 5% year-on-year growth, and definitely very strong performance on some of our key drivers of the business, as I'm going to share with you in a few slides. Our EBITDA, as always, EBITDA and net profit has grown even at a faster and stronger pace than the revenue. So our EBITDA stands at 38.8% and grew 8% year-on-year, and the net profit at almost 35%, 34.9 to be exact, and 7% growth year-on-year. Our free cash flow has as well stood at a performance of 96% conversion, which is again our highest since its inception of the company, and definitely over the last 5 years since I took over. So very pleased with this as well. More or less, our number of products stood steady, although we got some approvals from Saudi FDA, but not yet launched. And we'll see more updates on this on the second and third quarter results as we move on throughout the year. Our units produced stand at almost 14 to 15 million per month, so it's about 15% year-on-year growth, and definitely we stand at a good build of our strategic stocks. Next slide, please. Yeah, so these are just some key highlights to bring some more flavor on the performance. So as you would expect, we were definitely as a business and as a region hit by a couple of things in the first quarter, both uncontrollable, as you would say. The first one is definitely the war that commenced later in February and impacted us in the most of March in some of our key markets, as I'm going to share with you. But more importantly, Saudi Arabia, which is our key market that represents more than half of the business, the external market dynamics didn't stay as we forecasted it. As a matter of fact, the market in the first couple of months here to date February, the Saudi retail market, as per the IQVIA data, stood at -7%. Within the same data, Jamjoom Pharma had a -2% compared to same period last year. So we performed better than the market, but definitely that's a market that we expected that it will grow at least at 8-9%, as I shared with you in the early year expectations. But definitely the market showed us different direction at the first couple of months of the year. We haven't got March data, but we'll keep on updating you as we move on with our earning results in the coming quarters. Moving annual total in February, the retail market in Saudi stood at 8.6%. But that obviously included 10 months of last year, um, which is impacting it. And we stood at Jamjoom Pharma within the same data at 23%, so almost 3 times the market growth, which is as strong as we always perform. In another dynamic that we have seen within our internal business is the fact that in first quarter 2025, we have seen almost 150% growth, as some of you will remember, in our institutional and tender business in Q1 25 compared to Q1 24. So almost 3 times growing the revenue there. In Q1 26, we stood at the same revenue of Q1 25, was a little bit improvement, which shows that we are definitely running at a higher rates, but the dynamics of the tender had changed on us in terms of ordering and phasing, which impacted our tender business as well in the first quarter. So we didn't see, obviously, we didn't witness the same result, the same growth. Another key point that we keep on monitoring and watch is that when we further analyze the IQVIA data and we look at only at the consumer health driven products, because we have a vested interest in this, we have a strong portfolio on the consumer health. When we analyze this, we see even more decline in terms of the growth compared to last year, which shows us that the out-of-pocket spend or the consumer spending is getting more cautious and definitely less driven than what we have witnessed in the last few years. So no complaints. The Saudi market had a very good run for 5 years. We expect the business cycle to show some fluctuation, but we're definitely hoping and we aspire for a better performance for the overall market in the remainder 10 months of the year. Otherwise, definitely it will impact all players in the market, us included. When you look at our export market performance, a mix, basically, Gulf markets have shown 9% growth, solid growth, but majority of this happened in the first couple of months of the year, Jan and Feb. Definitely, we have seen the Gulf impacted during the months of March. Gulf and Levant, definitely due to the war and some of the dynamics that you are aware of. Places in the Gulf like Bahrain, United Arab Emirates, and Kuwait were the most impacted by the war, and they got hit repeatedly, and different unfavorable dynamics happened in these markets. Iraq as well, we have seen that because of the stricter regulations on both import and export, us needing to get more approvals both in the domestic market in Saudi before we export to markets like Iraq, so that they ensure that we are not exporting on the cost of our products not available in the inception market, Saudi Arabia, and as well when the goods go there, stricter and the later approval of releasing the goods or approving the goods to get into the market. So that impacted our sell in to the market in some ways. Egypt, on the other hand, although we did very well on the sell out to the customers, and the team has performed well, but some of the phasing issues in the market because of certain market dynamics impacted us by 2%. But no concern from our side there. Portfolio transformation, basically, when we look at, as I'm going to show you in details in the coming slide, you will see very strong growth on the cardiometabolic, led by the type 2 diabetic portfolio. Very pleased with this. It shows that the strategy is working in action and moving in the right direction. We got 3 registration in the first quarter. So we expect this product to be launched and contributing to our growth as we move forward. And definitely, we continue to have almost 60 products in our pipeline, in addition to whatever we get from our business development activities as licensing in products from outside. We signed 4 agreements on that front, and some strong products both on the anti-infective front, some specialty and some cardiometabolic or cardiovascular products, which again will definitely add value to our already strong and diversified portfolio in the coming quarters. From a manufacturing perspective, we continue to operate on a strong performance in the existing facility, or the Inception basically facility in Saudi Arabia and Jeddah, 93 to 94% utilization. As well, the Jeddah trial facility, we're very pleased with how we are ramping up this facility, and we're almost reaching above 70% utilization with strong growth year on year. And Egypt, we are getting into 60%, and we expect toward the end of the year we will get into 75% utilization, 70 to 75. So again, very pleased on that front. Move on, please. Next slide. Yeah. And here, as I was sharing with you, you can see the strong performance on the left-hand side of the slide by therapy area. So 10% on the ophthalmology, which is a mature and leading portfolio for us that continue to be a market leader in our key markets, still showing 10%, which, as you can tell, is above the market growth in many of our key markets. 36% for the cardiometabolic, as I told you, driven mainly or primarily by the type 2 diabetic launches in the market of Saudi Arabia. Again, very pleased with this. Primary care, which is a lump of a summary area or a cluster of therapy areas that you haven't seen before, but I spoke to you about, which now represent for us general medicine and pain and inflammation. So we lumped all this together, and GIT. So almost 4 or 5 therapy areas under primary care, which is majority of our established product, as we would say. So that grew nicely as well by 9%. Consumer health were impacted really heavily in the first quarter, again on the sell to distributors, but our in-market sales were as strong and robust as ever. But the shipment or the sales to distributor were impacted by 2 products. One is an iron product that we had strong demand, but we didn't get the supply on time in the first quarter, but I think it's sorted as we speak. And the second one is a key addition to our portfolio, recent addition, which is a probiotic, the Pro-Life, that had fluctuating regulatory approaches, whereby they wanted to move it from a pharma product into food and then back to pharma again, which really put us in a paralyzing situation for almost 3 months, not able to import the product and get the product into the markets. This situation is resolved, I'm pleased to say, by mid-March, and from this month onward, hopefully we'll have it back. So that's basically on the consumer health. Dermatology, again, a mature portfolio. You start to see some rationalization of some of the old products. Some of the of the key strategic products there are still performing very strong and representing a healthy growth, but more on the old products, we are witnessing this minor decline, -6%. If we look at this country by country, on the right-hand side of the slide, the top graph, you see that Saudi, strong performance, 6%. Our on results compared to the market that is declining by -7% as we spoke. Gulf, +9%. So these are our 2 really markets that represent a big portion of of the business above 75%. Then Iraq was impacted a little bit. I don't want to repeat. I shared this with you. North Africa and other exports, strong performance, plus 7%. And Egypt, as I said, because of the phasing, that it's our ongoing, and it's a plan that we had already in our sales, minor change from last year. If you look at this on the bottom right-hand side of the slide, by strategic, established, and new product launches, the contribution to our growth from where we landed last quarter or first quarter last year compared to first quarter this year. As you can see, big portion is driven by us driving strategic brands. 77% of this growth came from driving strategic brands. So again, very pleased with this. It shows that strategy in action is moving in the right direction. Established brands were as established as it could be. So it was like stable, or it didn't deliver any growth, but stayed more or less without showing heavy decline. And new product launches contributed by 24% of such growth. So pleased that the strategy is really paying its dividend on the strategic brands transition and focus. Next slide, please. Yeah, that's a slide that I always share with you and update you with. And we always benchmark when we start this journey in 2021, how did our portfolio play versus where it is today. And as you can see, ophthalmology and dermatology remain the backbone of the company, still representing 44%, but down from 55%, while the 11% transition has moved into positive and very strategic, but higher revenue and focused areas like cardiometabolic, some products on the primary care front. Consumer health, as I shared with you, was impacted by the supply issue and the regulatory paralysis on one of the products, the decision making, but we got it resolved by the second half of March. Moving forward, next slide. Yeah. So again, an update on our key strategic initiatives or projects that we are busy running along with our day-to-day business. The first one you are becoming familiar with, which is the JV with PIF, represented by Lyfera, us commissioned by the government of Saudi Arabia to localize vaccines, biological/biosimilars. Pleased to say that the shareholders agreement is almost in place now, and awaiting for us to co-sign along with our partners there, and we'll let you know about this in due course. We expect this to happen in the very short term, within a week or two from now. Manufacturing, we continue to look obviously for how we are going to fuel our growth that will happen year on year. And based on this, we started to really look seriously at certain transactions that we need to perhaps look at to finalize our expansion plans along with our internal directions into this regard. And you will hear about this in a very short due course, us completing a very strategic transaction on this front. Very pleased, and I'm sure some of you have seen already the announcement we made today, along with our earning results, that we have finalized the agreement with Viatris, the global company represented by its regional representative, Viatris Arabia, to manufacture most of their established products in our facility in Saudi Arabia. Definitely to supply the market of Saudi, a very strategic alliance that I'm pleased with. I have myself have some emotional accounts with many of these products because I was handling it in my former capacity as a regional president for Pfizer. And definitely high quality products that we are very pleased to contribute to its national sufficiency in terms of supply basis in the coming years. So a deal that will be followed perhaps by similar deals as we move on, and we'll keep you posted. From a portfolio diversification point of view, we continue to explore in-licensing opportunity, acquisition opportunities, as well as strategic alliances with some of the players in the marketplace that are well known, so that we can really continue to enrich the portfolio, but more importantly, fuel our vertical growth as much as we did in the last few years, fuel strongly our horizontal growth. So watch the space in this front, because you might hear as well in the coming few quarters about our progress in this regard. As well, we definitely in markets like the Gulf and some other markets, we are seeing a lot of serious directions by regulators and governments to see us localizing our brands there, again, as a matter of national security for them. And we are looking at this seriously in some of the key markets in the Gulf and other strategic markets for us. How can we really enrich our local presence by certain deals that will show our seriousness in approaching these markets? We'll continue to update you as we finalize some of these initiatives. With this, I think I will move to Anwar to take you through the financial results. Anwar, if you can go ahead.
Thank you, Dr. Tariq. Good afternoon, everyone, and thank you for joining us today. I would like to reiterate what Dr. Tariq said earlier, that Jamjoom Pharma delivered a positive first quarter performance, setting a solid foundation for a sustained growth momentum in 2026. This performance highlights the strength of our commercial execution and the growing contribution from our strategic initiatives, especially during a challenging and economic geopolitical environment. As we move to the slide on the cost front in quarter 1 2026, we maintain a strong focus on operational discipline, ensuring that cost growth remained below top line growth. Importantly, cost of revenue increased at a slower pace than the revenue, reflecting ongoing efficiencies as well as the benefits of a favorable product and customer mix. Looking first at production costs, these were broadly aligned with higher manufacturing activity required to support demand. Raw material and consumables increased as expected, in line with the higher production volumes. Salaries and employee-related costs reflect the second phase of our enhanced employee reward program, which is critical to retaining and motivating key talent. Depreciation and amortization rose following the capitalization of recently completed assets. Other operating costs, including utilities and maintenance, remained broadly in line with the business activity. Moving to the right-hand side of the slide, total operating expenses increased modestly. R&D spending grew at normal pace, reflecting continued investment in our pipeline and product readiness. Selling and distribution expenses increased in line with the targeted commercial support behind our strategic brands. G&A expenses remained well controlled, benefiting from discipline and overhead management. Finally, I would like to highlight that cost per unit remained stable, supported by operating efficiencies and continued shift towards higher value strategic brands. In summary, our focus on strategic brands, high impact spending, and cost discipline continue to translate into strong profitability, improved operating leverage. Let me move to the next slide. This slide highlights the tangible outcome of our operating discipline of margin expansion. In quarter 1 2026, EBITDA margin increased to 38.8%, up from 37.7%, reflecting continued strength in execution across the business. This expansion was driven by several reinforcing factors. First, we continue to set a favorable shift towards high margin product, which improved overall mix. Second, stronger volumes in retail channel delivered better operating leverage, allowing fixed costs to be absorbed more efficiently. And third, this was supported by disciplined cost management across the organization despite ongoing inflationary pressure. Importantly, this performance was not driven by one offset effect. It reflects sustained momentum in our core operation, consistent product mix improvement, and scale efficiencies from our expanding manufacturing and commercial footprint. As a result, we are now operating as a structurally higher margin level. This consistency of recovery and elevated margin profile reinforce our resilience, our business and model, and our ability to execute effectively even in more challenging environment. Overall, this margin progression underscored that our strategy focused on mix, scale, and discipline is translating into durable profitability improvement. We will now move to the cash conversion cycle to the next slide. Lastly, let me touch on working capital, where our focus remains on supporting growth while maintaining strong liquidity and financial flexibility. As of Q1 2026, the cash conversion cycle improved to 279 days, down from the 285 days in Q1 2025, reflecting continued progress in managing the operating cycle. This improvement was primarily driven by better inventory performance. Inventory days declined to 147 days from 179 days last year, reflecting enhanced inventory planning, improved demand for forecasting, and increased production output from both Egypt facility and Jeddah facility. At the same time, receivable days increased to 170 days from 151 days, reflecting a higher proportion of sales to the institutional customer, which carry longer payment cycle. Payable days declined to 38 days from 45 days, driven by the normalization of supply credit terms and our continued effort to strengthen long-term strategic supplier relationship. As a result, working capital reached 886 million, up 13.7% year-on-year, largely in line with revenue growth and business expansion, particularly higher receivable linked to increased institutional sales. Despite this growth in investment, we closed the quarter with cash balance of 206 million as of March 31st, 2026, even after the payment of 140 million dividend during this quarter. This solid cash position, together with free cash flow of 180 million generated in Q1 2026, gives us ample liquidity to fund ongoing growth initiatives while maintaining balance sheet strength. With this, I would like to hand over to Dr. Tariq for his closing remarks and outlook.
Okay. Thank you, Anwar. So basically, we stay solid behind our guidance that we shared with you before on the revenue growth. We stay solid on 10-12%. Also, I showed you that the Saudi market is really didn't show solid moves in the first couple of months. We are hoping that this will change, and we'll continue to update you as we move on. On the EBITDA margin, we're still solid on the higher end of the guidance at 35%. On the CapEx, the 6-9%, the same, and basically on the dividend front, the 50-60% of payout of dividend on biannual basis, subject to obviously business performance and needs. So with this, I will perhaps stop here and invite any questions from your sides.
Thank you, management, Dr. Tariq and Mr. Anwar, for the detailed presentation. We will now commence with the Q&A session. You may raise your hand by pressing the hand icon button on your screen to speak with the management, or alternatively, you may drop your question into the Q&A chat box. With that being said, please limit your question to 2 at a time so we can accommodate as many participants as possible. You are, however, more than welcome to join back the queue if you have any follow-up questions. So without any further delay, Q&A session is now open. Our first questions come from the line of Mashal. Mashal, I am unmuting you.
Assalamu alaikum. Am I audible?
Yes, you are audible.
Hi, Dr. Tariq. Thank you for the presentation. Just quick question from my end. You just commented on Saudi performance, and I've been seeing the regional top line. Saudi printing around 6% year-over-year growth, and then the overall top line for the group only almost 5% top line growth year-over-year. And given that the first quarter is one of your best in terms of volume, how are we going to compensate and reach the guidance by the remainder 9 months?
Hi, Michelle. I'm not sure about where you are heading with your question. Are you saying that if Saudi performed only at 5%, how we are going to commit to the 10-12% as we move on?
So maybe it's a two-part question. The first one is regarding Saudi. I mean, ever since 2023, Saudi performance in terms of top line has been reporting very solid numbers. Except one quarter where it reported decline due to delivery issues. So that's the first one. Where are we seeing Saudi going forward? And then the second question, how are we meeting the guidance given that the top line of the group in the first quarter only reported 5%? And you're guiding a CAGR of 10 to 12 for 26-27.
Yeah, I mean, it's basically you are done with 26-27% of your year. You are still left with the remainder, which is almost 3/4 of the year, 74-73%. So definitely the majority of the business is still ahead of us. We can compensate, subject to a couple of things. If that's what your question is about. And I think you can guess this yourself and the rest of the audience. First, the war doesn't continue because, of course, the impact of the war is really at the moment a little bit predictable on the Gulf area, unpredictable on Saudi and the rest of the region, but more importantly, the global economy as well. And Saudi market to go back, the external market to go back on the normal performance. Because as I explained already, I mean, we are operating within an overall market. And if the external market doesn't perform, we build our forecast based on the market growth. And if the overall market doesn't perform up to expectation, then it will be difficult for us to deliver on the commitments. However, I think definitely we are still committed to our guidance because of a couple of things. First, we put our bets on the Saudi market and the overall market to come back into at least stabilize the growth. Maybe not as much as we forecasted, but at least stabilize the low-digit growth. And that will still enable us to commit to our numbers. And as well, definitely the very strong diversification that we have done in our business, whereby we have other markets now that can contribute into covering up for some of the growth if the Saudi market didn't do it. However, the second portion of this is really material and subject to if the war doesn't continue and we have a stabilized geopolitical situation within the region. That's why we didn't want to take the pessimistic scenario yet and to tell that we don't have strong confidence in the remainder of the year. We actually do. But at the moment, it's too uncontrollable that we are not sure basically how they will evolve. Saudi market go back to low-digit growth at least, and the war is stabilized.
That's clear. So we're seeing that the growth will be substituted from other regions rather than Saudi if we're going to see a single-digit.
Couple of things, yeah, Mashal. Couple of things, because I mean, we're inshallah, yani, with our formidable business and the strong foundation, we are not out of ammunitions and options here. Definitely, we can continue to have growth in Saudi. As I told you, I think the mandate from my side is that we go back in the Saudi market into at least low-digit growth. if we do this, then we'll be able, even within the Saudi market, playing on both the institutional and tender, as long as the retail, to really outweigh our perhaps performance in the institutional and the retail in the coming 9 years, stabilize slash grow our business in the retail, and that will enable us to give our Saudi commitments. On the other hand, subject to the geopolitical situation in the region, as I said, we have very strong potential that we are seeing in places like our other export markets. Egypt that is back on strong performance. Gulf as well, high potential in Gulf and Iraq to drive growth. So if things stabilize, I think we are still very bullish about how we can deliver on our commitments. But yeah, I mean, it's things stabilizing is really up in the air at the moment, as you would expect.
Clear. Thank you. That's it from my end.
Sure.
Thank you. Thank you, management. Our next questions come from the line of Maha. Maha, you can unmute yourself and ask your question.
Assalamu alaikum. I have two questions, one of them asked by Misha'il, and the other one, if I may, I saw your days receivable increasing to 170 days. As the market now characterized by higher tenders, is this going to be the new level for Jamjoom going forward?
What's your first part of the question, Ma?
As the tender market is growing and we see a lot of tenders happening, is the 170 days receivable is the new level for Jamjoom going forward?
No, I heard this one. Do you have another question, or that's your only question?
No, that's the question. Only question.
Thank you, ma'am. Thank you. And hello again. Yeah. So basically, if you look at our, I always explain that or try to explain this, Maha. If you look at the way we conclude our financial year, with no exception since 2022. You'll come at the end of the year and you'll find our days receivable standing at perhaps something within the 120 to 130, hardly reaching the 130. You come in the middle of the year, especially the first quarter, where people just paid their dues in the end of December, so that they close their financial year and enable us as well to close on the positive note. They come on the first quarter and we see a little bit of a late payment from both retail, mostly retail, quite honestly. If you look at the same quarter last year, at the end of the same quarter last year, you will find our days receivable at 150 plus. So not far from what you are seeing today. Today, obviously, and you are spot on this, our results today are complemented by the fact that people on the retail side or the distributors are telling us that, yeah, I mean, we're not getting payment on time from key customers. So we are seeing some issues in the Saudi market, which is causing basically the decline that I spoke about earlier on the relatively poor performance in the first couple of months of the year. We are seeing some liquidity issue and working capital issues in the market, whereby it's not as strong as we have seen in the previous years. We're hoping that this will get resolved over the coming months, and we'll go back on a healthy days receivable. But it's not so much of a concern for us at the moment, because we fluctuated between 150, 160, 165 normally at the end of the first quarter in the previous years. So it's not so much of a concern, but we'll keep updating you as we move on.
Thank you, management. Our next questions come from the line of Ibrahim. Ibrahim, I'm unmuting yourself. You can unmute yourself. Yes.
Thank you, Jazeera Capital. Congrats, Dr. Tariq, Anwar, and Mohammed and Khalid for the great results. Few questions from my side. The first one, excuse my ignorance here. You've mentioned you're facing issue with importing consumer health products. Just to understand the business, so you don't manufacture it here locally. You import repackage and resell it, or what's the business model here?
Thank you, Ibrahim, and good to have you and welcome you back. So listen, no, like any of our portfolio products, I mean, we have majority of our products are done in-house. You're not wrong in assuming this, but some of our products we bring from outside because, as I always shared with you, speed to market is key for us. But as well, our ability to manufacture certain products. The product I'm sharing with you, Ibrahim, ProLife, is a probiotic. So that's not a product where we have the expertise to manufacture, at least at the moment. Maybe as the business grow, maybe, and as us as well, getting more sophisticated in maximizing our abilities from a manufacturing point of view and know-how point of view, we can. But at the moment, we bring this product from South Korea and we sell it in the Saudi market. So it wasn't the difficult in importation per se, but it was much of authorities telling us this is a product that is first registered as a pharma product, but we might now move it into a food product. Okay, we said fine. We'll wait until we get the new change, and then we'll get the products from outside. And then that took us some time, and then they came back and said, no, as a matter of fact, we believe that we'll keep it as a pharmaceutical product. That wasted almost 2.5, 3 months for us at the beginning of the year to be able to put the order for importing, because we're not sure. We have to get the final registration. We have to get how the product is going to be treated so that we can place the order. And because of this uncertainty, that was the delay. But now it's resolved, as I said, and we'll be able to move forward.
Excellent, very insightful as usual. Is this also applied to some pharma or
no,
only
no,
to
no,
the
no,
consumer health
no,
products
no, no.
in
This
terms of
happened
importation?
quite honestly.
Not
Quite
the
honestly.
regulatory changes. I'm referring to the manufacturing capabilities.
From manufacturing, majority of our products, as well as I told you. So, for example, look at some of our flagship therapy areas like ophthalmology. Almost 95, 96%, if not more, of our products are made in-house. But we have certain products that we found that they are more advanced. They are really going to be meeting critical demand in the market, and we cannot do it instantaneously. So we got it from outside while we build the capability inside to manufacture it. So we get some products from Italy, some from other places, but majority are made in-house. And hence and forth, if you apply on majority of our portfolio. But as I said, as we move forward, Ibrahim, so that it's a clear message to you and everyone around. As we move forward, you are going to see more and more directions into sometimes getting more products from outside to meet our key intent, which is speed to market. If there is unmet need in the market, we are not going to wait until we build the capability inside. We'll get it from someone, but we'll definitely mention in the contract that we will have the right in few years' time to localize the product and get the tech transfer and the know-how transition from your side. So that will always be our approach, because speed to market is the name of the game for us.
Yeah, very, very clear. It's licensing and supply agreements.
Absolutely, absolutely.
Clear. Second question from my side on the market overall, private and public. If there is any accelerated deliveries during certain month, either March or April, due to the geopolitical situation in the private or in the public, if there is any direction for a certain restocking, as it was the case during COVID, for certain period. You've mentioned also certain constraints on exports. How significant is this? Is it applied on certain areas? And also the if you look at the, I'm sure you looked, but certain questions on the month growth within the private market. Jan was down only 1%. Feb is down by 11%. Is this seasonality? Is this? You've mentioned also the consumer health softening. Other than the consumer health, the other products, what are you seeing there? Is there anything concerning or market as usual and business as usual overall?
Wow, Ibrahim, that's almost 10 questions in one, huh? But yeah, I'll try. Listen, I'll give it a go, and then you remind me if I forget to handle any of your multiple questions. So first,
I'm limited to two questions. That's why I clubbed few ones and two and two
yeah.
ones.
So first, yeah, I understand. So, one question was there was 9 subtitles. So listen, I think the key portion of your question really, which is I'm glad you asked it because I'm sure it's in the minds of people, and I would like to clear it once and for all. This is not COVID, guys. This is completely the opposite of what we have seen in the COVID period. Why am I saying this? Um, First, during the COVID period, I mean, people were suffering from a pandemic that they knew that it will take some time and go. Little impact or more impact on our region or our part of the world than the global impact that is expected everywhere. People are sitting in their homes, working from homes, worried to get the disease infected or moved to them, but more importantly, taking their health into their own hands and taking initiative to buy the likes of vitamins and the immune boosting products and stuff like this, so that they can really work on the prevention rather than waiting until the disease hit them and then it becomes a little bit more serious. So that was all positive. In addition to the point you mentioned, Ibrahim, which is authorities said, okay, because of the bans on imports and whatever, we would like you to double down on your stocking at the distributor level. So if your average is 3 to 4, make it 6 to 8, and hence and forth. This is completely the opposite. What we are witnessing today, people are not sitting in their homes, but perhaps they are pushed not to leave their homes because of the insecure situation. And we have seen this in the Gulf, mainly Bahrain, Kuwait, and others. So they are forced to stay there. But because of unpleasant situation as opposed to a transit pandemic. But more importantly, people are uncertain about how the region will evolve, how each country will evolve economically, geopolitically, and everything else if this war are extended. So, as I alluded to earlier in my introductory slides, we are seeing even more softer way of consumers approaching medications like the multivitamins, like the immune products, and hence and forth. So they are cautious about where to spend their money and how to spend their money. So that shows the differences from the era of COVID. As well, before even the COVID, as I told you, Jan and Feb, we are seeing in our key market that represent 50% of the business issues with working capital and with liquidity. So this is all definitely adding into the issue that we are witnessing in the market, and then it was definitely over dramatized by the war at the end of Feb and the whole of March. Unlike the COVID period, to your point, Ibrahim, authorities are not pushing us to overstock or to stock more products. On the contrary. However, they are witnessing and that they are monitoring the situation as it evolves. And they are ensuring, and this is referring to your comment on my earlier remarks about stricter import and export ways, where we are seeing two parallel directions happening at the same time, Ibrahim. One, from the Saudi authorities, they don't want to create panic, so they are not pushing for building stocks. Because that as well, learning from the COVID period, it didn't impact the market well, because while people did this up to the end of 2020, they came in 2021 and had to destock, and the markets witnessed a period of uncertainty. So they are not pushing for this now, but they are ensuring, like with the likes of companies, domestic players like us, that we are not exporting on the expense of supplying the domestic market in full. So every order now, so before the war starts, we were definitely exporting smoothly, getting the right approval that we need internally, and then sending goods to the markets outside Saudi Arabia based on demand and agreements with our distributors there. Today, the regulators in Saudi said, okay, you have to let us know about the products, the quantities that you are going to send outside Saudi Arabia, and then they will look at the same products in Saudi. Are we really satisfying? Do we have enough stocks in the market or not? If not, they will definitely block our order. So that's a new regulation that we didn't have before that is delaying our efforts to export products. On the other hand, when we succeed to export, I mean, because of, again, the war and the prioritization from regulatory staff and the governments on many fronts, there are delays in accepting and releasing the goods, and which is delaying us from claiming, because we don't claim sales until the goods reach the end market and the distributor give us enough evidence that they have received it. So all this is contributing to the fluctuation in sales in a market like Iraq that I shared with you, the minus 2% that you have seen, and hopefully it doesn't get exacerbated in the coming months if the situation continue to evolve.
Very, very clear, Tariq. You've tackled all. Just if I
Ibrahim,
may.
sorry to interrupt you.
Yeah, sure, sure.
Yeah. Thank you anyway. Thank you.
Thank you.
Thank you. Thank you, Dr. Tariq, for answering in detail. We will now move towards the Q&A chat box, as we have some of the questions we have received so far. Saud is asking about your 1Q revenues. Out of 481 million revenues, how much percentage of the revenue comes from the public market and private markets?
Sorry, I didn't get the question, Abdullah.
So Saud is asking about your revenue composition between public and private markets during first quarter.
Yes, I mean, yeah, as I said, we did well on posts. We're up to our expectation on post size. As I said, the public and the tender market, if that's his focus of the question, came at the same or slightly higher sales than Q1 25, but definitely we didn't witness the same growth that we have seen Q1 25 compared to Q1 24. That's different dynamics on ordering and changing the tender process in Saudi Arabia, as I alluded to in previous calls. So we expect that as we move on in the remainder of the year, the coming 9 months, our institutional and tender business will be even stronger as we do more deliveries, and hopefully we will show even more robust growth as we move on as compared to the first quarter, which witnessed this one-off analogy between Q1 24, Q1 25, and Q1 26.
Okay.
By the way, Abdullah, if we finish within time, I would like to go back to Ibrahim as well, because he seemed like he had still burning points. So let's handle the others, and if we still have time, I would like to go back to him.
Sure thing. So the second question posted in the chat box, if you can give some guidance about the seasonality in your business, like why your first quarter always has the highest share of annual revenues, if you can comment on that.
Yeah, and I did comment on this repeatedly, but I'm more than pleased to comment on it again. As I said, we have two lines of activities from our teams going in parallel all the time, guys. The sales to our distributors, so from our plant or factories to our distributors, which we call it the shipments or the to-market sales that you see in our official books, because that's the key dynamic that we refer our sales and our revenue and all the results to. So that happened at a more assertive front in the earlier part of the year, as I always explain, so that we guarantee that we have the goods and all the demands that we expect will be created, subject to the growth we forecast for the year, will be satisfied by goods sitting with the distributors and them able to supply. Because the last thing you want is that you plan 10-12% growth on your top line in your numbers. This come to the distributor in the form of orders they cannot satisfy because they don't have enough stocks from the brokers. So we do this in the first 9 months of the year, mostly more on the two first quarters or the first semester of the year. Third quarter is slightly less, and the fourth quarter is normally the lowest. Having said that, the other barrel activity that is happening day in, day out, hour in, hour out in our business is the in-market sales, whereby our distributor sell to the pharmacies and the accounts and the hospitals and the institution and the tender, satisfying demand created and orders by these people. This doesn't have the same seasonality that you see. This is almost moving more or less 25% of the business months, quarter on quarter, more or less. It doesn't see the same slight fluctuation. But we do the other one, on the two market sales purposely, as I said, for two reasons. First, to ensure that whatever demand is created by our troops and their teams are going to be satisfied by products available on the shelves to be sold. And the second thing is that we don't want the last quarter to become very strong so that it comes and haunt us badly in the first quarter of the following year. We don't want people to channel stuff or to have a lot of goods at the end of the year to finish their financial year, and then they come in the first quarter of the year and they don't order enough from us because of the channel stuffing in the previous year. So we guard against this too. It worked very well for us over the last few years, and I expect it to continue to do so.
Thank you, Dr. Tariq. We will now move towards the hand raised. Yasir, you can unmute yourself. Yasir?
I'm audible?
Yes, you are audible. Please go ahead.
Thank you. Thank you, management, for the presentation. I have two questions from my side. My first question regarding the capex as a percentage of revenue stood at 1.3 versus the guidance from 6 to 9%. So my question is, what is the expected capex spending in the second half, and what project will it cover? My first question.
Yeah, I mean, so these are this is business as usual for us, Yasser, and it's again a similar trend to what we have seen previous years. So people start slow on because capex, don't forget, these are machinery, either parts of machinery or full machinery or other stuff that is related to our manufacturing facility placing orders. So I mean, you have to satisfy few folds in order for us really to spend the money or commit to the money. You show your demand for the machinery, but more importantly, the supplier show that they can provide the machinery on time for you so that you can place the order on that front. And sometimes there is a fluctuation in this. It doesn't happen really every quarter you close at the 5 to 6%, but it increases on the second half of the year normally. What is this satisfying? It's basically, as I said, business as usual, whereby you get upgrade of existing machinery, new machineries. New machineries will be mostly in the case of projects like Algeria. As you know, we are building an OFSA facility there from scratch, and we keep on ordering machinery. We upgrade our existing plant in Jeddah as well, because we have a lot of machinery that have reached its time, and it either gets replaced or it gets seriously upgraded with spare parts and whatever. And obviously, as the business grow, we need faster machines. We need better machines in terms of our packaging, in terms of many other stuff. So that's more or less business as usual for us in terms of the capex. And today, as you are aware, we are playing with 3.5 plants, Algeria being the half, until it fully stands on its feet, compared to just one facility 2-3 years ago. So obviously, hence we increased our capex from 4 to 6% guidance in the previous guidance period into a 6 to 9% in anticipation of what we are going to spend, both on the existing facility, but as well on other business initiatives that we are doing at the moment, and you will hear about it in due course. But yeah, we expect that we will land on the perhaps not the higher end, perhaps not the 9, but definitely we will land something between the 6 and 8% at the end of the year.
Clear. My second question is regarding the gross margin improvement in this quarter comparing to the same quarter in previous year. So was it product mix or manufacturing efficiency or lower input cost?
Yeah, good question, actually, Yasser. And that's I alluded to this modestly during my presentation, but now that you focused on it, I think that's really, I mean, it's really pleasing for me to keep on reassuring for you as loyal investors and analysts, and that the company you are really putting the trust in and making a reference for the pharma industry in Saudi, namely Jamjoom Pharma, is really they keep on delivering on their commitment and find ways even at the toughest times. And that's us here in crystallizing this, whereby even when we deliver less than expected growth because of the dynamics that we all discussed, because of our earlier initiatives that we have taken a couple of years ago into segmenting our portfolio into strategic and established, and making most of the focus of our teams to go on the strategic products that have the phenomena of high growth potential, high revenue, and high margin. Because of this, you are seeing the real strengths in driving the net profits and the EBITDA even at a stronger pace than the top line. 5% on the top line, 8% on the EBITDA, 7% on the net profit, and it's driven by our performance on the strategic products. And we expect to continue to do this as we move forward. Most of our rep efforts, most of our investment in the market in terms of promotional activity, marketing activity, will definitely go to a higher proportion behind these strategic products. And the other product, the established ones that still are, some of them are cash cow for us and very strong for us and important, we find different means and ways to promote it and to sell it. So this diversification and distinction of our portfolio that we started earlier in the journey a couple of years ago is paying us very strong dividends in a tough time like this, whereby it's really boosting our performance in a very good way. And I'm very pleased with this.
Thank you, Dr. Tariq. We have another hand raised from Madhu. Madhu, you can unmute yourself.
Thank you. Thank you, Abdullah, for the opportunity. Hi, Dr. Tariq. A couple of questions. One is on the acquisitions. You mentioned in the press release that you have planned something and there is high possibility that it will be executed this year. Could you provide more details here? Are you focusing on getting access to higher manufacturing capacity through this acquisition? Or is it, access to a new therapeutic area? And also, if you can comment on which geography would it be? Would it be local or an overseas market? And a follow-up related to acquisition, does your CapEx target include the amount that you have budgeted for this acquisition? So this is question number one related to acquisition. Second, you talked about the challenges that you're facing in the Gulf. Despite that, you managed to achieve 9% growth, which is even more than the growth in KSA. So the challenges that you're facing, is it only demand related or is it related to logistics, and this challenges you faced in March and April, but not in Jan and Feb, and that is the reason you managed to achieve this 9% growth? These are my two questions for now.
Thank you, Madhu, and welcome back. Yeah, we missed you last time or last couple of times. Good to hear you back.
Thank you.
Listen, as usual, yes, important questions. The first one, I guess, so no, let me start with the second one, because basically there is no April in these results, as you know, Matthew. So our results stands up until March. And yes, Gulf has delivered, as I mentioned, strong results. Most of these 9% you are witnessing have happened in the months of Jan and Feb. Imagine if the war didn't happen, we would have had even a more marvelous performance over there. But here come March, and then you are really augmented by tons of headwinds and unfavorable situations. First, what's happening in Bahrain, or what happened in Bahrain, Kuwait, and UAE, Dubai mainly, and Abu Dhabi to a great extent as well. So that definitely impacted the people getting out of their houses, buying medication, or being in the mood even to conduct their normal life. So March really were impacted with this in these markets. In addition, definitely to logistical issues in getting goods into some of these markets. I mentioned the stricter export and import as well that impacted these markets as well. We're hoping that this situation will become better as we move on, if the war really doesn't continue for long and people come to their senses finally. We're hoping. Otherwise, yeah, we expect the Gulf area to become one of the most impacted area if the war continue to be the case. Your first question, so I wasn't 100%. I'm not sure what you are referring to. A portion of our release about the manufacturing facility that we might be embarking on getting. Is that what you are mentioning?
Dr. Tariq, if you allow me,
Yeah.
anything that we will disclose, you will know about it in detail. So for now, nothing is disclosed.
Yeah, but let me. I mean, I think it's fair that yes. So Mado, although I cannot give you the details to the nitty-gritty of your questions and the geography and whatever, we continue really to have ongoing, definitely initiatives into because yeah, I think you lived with us the journey from the beginning, Mado, and I know that you are one of the loyal attendees in all our analysts and investors call and other fronts. I mean, this is a company that delivered between 22 to 25, almost like 20% growth year on year. We more than doubled our top line. So in order for us to do this, we have to continue to really look at how we are going to fuel this expansion from a manufacturing facility point of view. And we continue to look for possible ways and means, challenging status quo on our existing facilities and ensuring that we get increasing efficiency, increasing effectiveness, do more with less, and all the stuff that we have done before. But more importantly, looking at as well options that are available in the marketplace. How can we complement our existing facilities by other facilities? Not every time we need to expand the facilities, we will go and buy a plant. Sometimes if you find a facility that is really going to be satisfactory to adding value to your existing ones, but more importantly as well, it can tackle other areas that you cannot do by just going internally, and every time you need capacity, you increase your own in your existing, or you buy your own, you build your own facility. More importantly, I think it adds to the learning, it adds to the experience, it adds to looking at how other people and how other companies are doing things and tackling things, which will complement and even further enrich in a stronger way our ability and our team's ability. So we look forward to continue to look at this. Once we finalize something, we'll let you know. But yes, we continue to definitely exhaust all our options internally and externally to ensure that we'll continue to be able to meet the increasing demand on our products by our customers.
Thank you, Dr. Tariq. This marked the final question for our session to conclude our call. Unfortunately, we couldn't take many questions, but we have collected the questions which have been posted in the chat box, and we will send them to the management. So if they can get back on that. So, and on the behalf of now Al Jazeera Capital, we would like to extend our sincere thanks to Jamjoom Pharma management for their time and the presentation, and to our guests for taking their time to join the call. I will now hand over the mic to Dr. Tariq for any closing remarks he may have.
Thank you, Abdullah. Thank you for facilitating the call. Thank you, all the attendees. It's always a pleasure to see you and chat with you. I'm sorry for people like Ibrahim and others who didn't get the chance to further extend the chats, but I'm sorry about the limited time. But we can tackle this in other fronts. I just assure you that the resilience of Jamjoom Pharma will continue to be the case, and we'll always find ways and means together to really keep on getting the best out the evolving situation that we have. We hope that things will happen in a better manner for the sake of the region and the people involved, inshallah, and we'll keep you posted. Thank you very much, and I wish you all a great rest of the day.
Thank you. Thanks, everyone. The meeting is now over, and you may exit the call. Thank you very much.
Thank you, Abdullah.
Thank you.